It's 1980s. Wall Street was money. Greed wasn't just good, it was policy. Traders make millions before lunch. Corporate raiders circle America's giants like sharks. But in a world blinded by greed, one man saw something different. He saw opportunity and risk and built a billion-dollar empire from scratch. History would remember him as the junk bond king. His name was Michael Milken. With one dangerous idea, the junk bond, he rewrote the rules of finance. High risk, high reward. It fueled billion-dollar takeovers, empowered underdogs, and made him one of the richest men in America. But the same weapon that built his empire would also destroy it. This is the story of junk bonds, how Michael Milken rose, how Ivan Boesky pulled him into scandal, and how it all came crashing down. Michael Robert Milken was born in 1946 in Encino, California. Unlike the flashy Wall Street stereotypes, Milken wasn't a Gordon Gekko type. While others craved the spotlight, he craved spreadsheets. He was quiet, studious, and utterly obsessed with numbers. His father was an accountant, and young Michael grew up surrounded by balance sheets and ledgers. From an early age, he developed a fascination with money, not just in the sense of wealth, but in how money moved. Who had access to capital? Who didn't? And why did the system favor some while shutting out others? That obsession followed him to the University of California, Berkeley in the 1960s. It was here that Milken stumbled upon the work that would change his life. W. Braddock Hickman's 1958 study, Corporate Bond Quality and Investor Experience. The study challenged everything Wall Street believed. Hickman analyzed decades of bond performance from 1900 to 1943 and came to a shocking conclusion. Portfolios of low-grade, high-yield bonds, the so-called junk bonds, often outperformed safer investment-grade bonds. The catch? They only worked if investors bought them in large numbers and held them over time, because defaults were inevitable. Hickman also issued a warning. These returns were subject to extreme aberrations over time. In plain English, junk bonds could be wildly profitable, but dangerously unstable. Where most readers saw risk, Milken saw a blueprint. A hidden opportunity. If he could harness this market, systematically buying and selling junk bonds, he could unlock a financial engine Wall Street had ignored. And it was in those dusty lecture halls that Milken found the idea that would define his career, reshape corporate America, and forever change the world of finance: junk bonds. At the time, the bond market was split into two worlds: investment-grade bonds, safe, issued by solid companies like IBM or AT&T; junk bonds, risky, issued by companies with poor credit ratings, often dismissed as financial trash. Credit agencies like Moody's and Standard & Poor's stamped their labels: AAA for the safest, BB or lower for the riskiest. Wall Street ignored the junk. But Michael Milken, he saw treasure where others saw trash. He saw opportunity where others saw garbage. After Berkeley, Milken earned his MBA from the Wharton School at the University of Pennsylvania, all while working part-time at a modest investment bank, Drexel Firestone. Now, you've got to remember, at the time, Drexel wasn't a Wall Street powerhouse. They were struggling. Compared to the big boys, JP Morgan, Goldman Sachs, and Morgan Stanley, Drexel was small, almost an afterthought, and that's exactly why Milken's idea mattered. His vision for junk bonds didn't just give him a career, it gave Drexel a way to leapfrog the giants and become a real player on Wall Street. It was here that Milken began pitching an idea almost no one believed in. Junk bonds could be the future. A bond at its core is just an IOU. You lend money to a company, and they promise to pay you back with interest. Now, if you lend to a giant, stable company like Coca-Cola, you'll probably get your money back. But the interest rate is low, safe, but boring. If you lent money to a struggling casino or a small energy company, the risk was high. They might default. To make up for that risk, they offered huge interest rates. These were the so-called junk bonds. High risk, high reward. Wall Street dismissed them as fallen angels, financial trash too unreliable for serious investors. Pension funds, insurers, and mutual funds stayed away, convinced defaults would wipe out returns. But Milken proved them wrong. His idea was simple but radical. One junk bond was dangerous, but bundle them into a portfolio and the math changed. Diversification spread the risk, and the sky-high interest payments more than covered the occasional default. On average, investors still came out ahead. And suddenly, small and mid-sized businesses had a lifeline. Casinos like Golden Nugget, Fast-growing firms, even family-owned companies, could now raise billions without begging the big banks. This was revolutionary. For decades, only blue-chip companies could tap into the bond market. Milken blew that door wide open. If a company paid back its interest and principal, junk bonds delivered far higher returns than the so-called safe bonds. This became Milken's gospel, and he was determined to prove it. In 1977, at just 31 years old, Milken led Drexel's first major junk bond sale, a $30 million deal for Texas International, an oil company. Drexel pocketed a 3% fee, double what safe bonds earned. It was a small deal, but a giant breakthrough. Buoyed by that success, Milken didn't just want to sell junk bonds. He wanted to build an entire financial ecosystem around them. By the late 1970s, Milken had moved operations to Drexel's Beverly Hills office, far from Wall Street's old guard in New York. From California, he quietly built a loyal network of investors and clients. Away from the spotlight, he was assembling something that would soon grow into a multi-billion-dollar machine and reshape the financial world. Milken's idea didn't just work, it rewrote Drexel's fate. And here's where the game gets interesting. Junk bonds weren't just giving small businesses a lifeline anymore. They had become the weapon of choice for a new breed of Wall Street predator, the corporate raider. Here's how it worked. Say you want to take over a company worth $5 billion, but you don't have the money. No problem. You issue $5 billion in junk bonds, raise the cash from investors hungry for high yields, and boom, you buy the company. This simple but ruthless strategy turned Wall Street into a battlefield. Milken's clients, names like Carl Icahn, who used junk bonds to seize TWA T. Boone Pickens, who launched billion-dollar raids on Gulf Oil and Unocal, and Ronald Perlman, who took over Revlon, became legends. Armed with Milken's financing, they turned junk bonds into the ultimate weapon for hostile takeovers of corporate America. CEOs who once thought their companies were untouchable now lived in fear of a phone call from Icahn or Pickens. And it worked. The junk bond market exploded from almost nothing to over $200 billion by the mid-1980s. Deals grew bigger, the takeovers bolder, the profits staggering. Junk bonds weren't just financing companies anymore, they were reshaping corporate America. But with huge money came corruption, and the rise of Ivan Boesky began. He was one of the most notorious traders on Wall Street. His specialty was something called merger arbitrage, basically betting on corporate takeovers. Here's how it worked. Imagine Company A wants to buy Company B for $50 a share, but right now Company B's stock is only $40. If the deal goes through, the stock will jump to $50. Arbitrageurs like Boesky would buy shares at $40, wait for the deal to close, and pocket the $10 difference. Sounds easy, right? But there was a catch. If the deal fell apart, that $40 stock might drop to $20 overnight. And instead of making millions, you could lose billions. That's why merger arbitrage was risky for most traders. Done legally, you were betting on rumors, research, and signals that could collapse overnight. But done illegally, it was a goldmine. If you knew in advance that a takeover was about to happen, you could load up on stock and make millions the moment the deal was announced. But Boesky was different. He often knew about mergers before they became public, through leaks, whispers, and back-channel deals. With that kind of edge, what was risky for others became a license to print money. That's called insider trading. But Boesky wasn't working alone. The web of corruption stretched deep into Wall Street's biggest firms, and the first to crack was Dennis Levine. Levine was a mergers and acquisitions banker at Drexel Burnham Lambert. He secretly ran an insider trading ring through offshore accounts in the Bahamas. In 1986, the SEC caught him. Facing prison, Levine cut a deal with prosecutors and gave up names. And one of those names was Ivan Boesky. Now here's what's interesting. Despite working under the same Drexel umbrella, Dennis Levine and Michael Milken weren't actually connected. Milken was the king of junk bonds, running the high-yield bond department from Beverly Hills. Levine worked in a totally different world, mergers and acquisitions in New York. They had no direct link, but the scandal moved like falling dominoes. Levine flipped on Boesky, Boesky flipped on Milken, and that chain reaction would bring down Drexel Burnham Lambert. Once exposed, Ivan Boesky struck a deal to save himself. He paid a record $100 million fine, agreed to cooperate with investigators, and even wore a wire. And the trail didn't end with Boesky. It went straight to Michael Milken. Prosecutors argued that Drexel's junk bond machine often overlapped with the deals Boesky traded on. Milken, they claimed, provided financing and even inside knowledge about which companies were being targeted with junk bond takeovers. Together, Milken and Boesky became symbols of the greed of the 1980s. In fact, Boesky himself cemented that reputation in a 1986 speech at UC Berkeley when he told students, "Greed is healthy. You can be greedy and still feel good about yourself." Sound familiar? That line inspired Gordon Gekko's infamous motto in Wall Street, "Greed is good." But by the end of 1986, Boesky was caught, and his cooperation gave prosecutors the evidence they needed to go after the junk bond king, Michael Milken. In 1989, Milken was indicted on 98 counts of racketeering and fraud, from insider trading to stock manipulation. A year later, Drexel Burnham Lambert collapsed, the biggest Wall Street failure since the Great Depression. Milken pleaded guilty to 6 counts of securities fraud, paid $600 million in fines, and was sentenced to 10 years in prison, though he served just 2. At his peak, he had earned $550 million in a single year, but his reputation was destroyed. After prison, Milken reinvented himself as a philanthropist. He donated hundreds of millions to medical research, especially after surviving prostate cancer, and founded the Milken Institute, a global think tank on finance and health. But Wall Street never forgot. For many, Milken remained the man who turned finance into a casino, fueling a culture of greed that would eventually lead to the 2008 crisis. So what about junk bonds? Did they die with Milken? Not at all. They were simply rebranded as high-yield bonds. Today, the market is worth over $1.5 trillion. Big banks like JP Morgan, Citi, and Goldman still trade them, but instead of fueling hostile takeovers, they now fund tech startups, emerging markets, and even governments. And here's the irony. Milken's vision was right. On average, junk bonds still outperform safer bonds, but the risks never went away. In every crash, whether it was 2008 or COVID-19, junk bonds were the first to tumble. Michael Milken was a financial genius who built his empire on junk bonds, legally. But then came Ivan Boesky, who thrived on insider trading and rigging Wall Street, illegally. Yet Boesky's story hits differently. His perspective on Wall Street inspired the legendary Gordon Gekko. To see Wall Street through Ivan Boesky's eyes, watch this video on how insider trading really works on Wall Street. Money never sleeps on Wall Street, and neither does on our channel. Watch all the mind-blowing Wall Street stories and explore intriguing money movies, all here in one place. Like this video and subscribe to The Money Game to level up your financial game today.